In this lesson, you're going to learn how to answer the most common questions in investment banking interviews on the topic of a DCF analysis. Probably the most common question is one that we just went over in the previous lesson, which is to walk the interviewer through the analysis. So I'm not going to repeat that here because we have an entire video devoted to it, but basically you just walk through the basic concept, summing up the present value of the cash flows and then the terminal value, and go into more detail depending on what they're looking for. After walking the interviewer through the DCF analysis itself, probably the second most common question is how do you calculate unlevered free cash flow in this analysis? So what you do there is you start from revenue, go down to operating income, and you stop there because it's unlevered, so you don't want to take into account interest income or interest expense. You multiply by the standard tax rate for the taxes, subtract the taxes, and then you add back any non-cash charges, so depreciation, amortization, stock-based comp. Then you subtract the increase in working capital, because if working capital is going up, then you need more cash to fund your business operations. So you subtract that because it's going to drain your cash flow. If it's going down, that means more cash is being freed up, so you have more cash flow. In that case, you add it. And then you subtract capital expenditures, and so you go from operating income, subtract taxes, add back non-cash charges, subtract the increase in working capital, subtract capex to get to unlevered free cash flow. Now sometimes they will try to trip you up with trick questions on this topic. One common one is how do principal repayments on debt affect the unlevered free cash flow here, or even the levered free cash flow? So if you're repaying debt or taking on debt, how does it affect the free cash flow? And the answer is that it doesn't. It's a trick question because going back to our three-statement model right here, remember that with the DCF analysis, we're trying to replicate the cash flow statement down to cash flow from operations and then capital expenditures. Anything to do with raising or paying off debt is going to show up in cash flow from financing activities, which means that it's not part of our DCF analysis. So it really has no effect on the analysis, and especially with unlevered free cash flow, it really has no effect because you're excluding interest expense and interest income. So just be cognizant of the fact that not everything is going to affect the analysis here. Only items that appear in the income statement, cash flow from operations, and capex will actually affect unlevered free cash flow. A related question here is how do you calculate levered free cash flow? So if we were looking at levered free cash flow instead, how would we calculate that? There are really two ways you can do this. One way would be to go back to our three-statement model and simply start from net income here, go down to cash flow from operations, and just take cash flow from operations and subtract capital expenditures. So that's one method for calculating it, minus capex. Another method for calculating it is rather than starting with operating income right here, we could actually start with pre-tax income instead. So we could take into account the interest income and interest expense, and then take it from there, go through all the same steps, and get to levered free cash flow. So we can use either of those two to calculate levered free cash flow. You may also get a question on what the impact of unlevered free cash flow versus levered free cash flow is. Now for this one, recall that back when we went over equity value and enterprise value, we said that when we're looking at these multiples, if we have levered free cash flow, we use equity value, and if we have unlevered free cash flow, we use enterprise value. Because levered free cash flow reflects what is only going to the equity shareholders, whereas unlevered free cash flow reflects what could potentially go to both debt and equity investors as well as preferred stockholders. So the short answer is that going along with that theme, in a DCF, unlevered free cash flow gives you enterprise value, whereas levered free cash flow gives you equity value. In terms of when to use which one, 99% of the time we use unlevered free cash flow in investment banking because we always want to get to the company's enterprise value. There are some scenarios which we'll look at later on when we might use levered free cash flow instead and use equity value based multiples, but most of the time we want to get to enterprise value, so we use unlevered free cash flow. A slightly more advanced question on this topic is when you're discounting the free cash flows, why would you use a mid-year discount period and what is the effect? So the reason you use this is because a company does not get all of its cash flow entirely at the end of the year. It's spread throughout the year. And by using 0.5, 1.5, and so on for your discount rather than 1, 2, 3, 4, 5, you're simulating this fact and more accurately representing when a company actually gets cash flow from its customers. And really the effect of using a mid-year discount here is that overall the value of your free cash flows will be higher because instead of discounting by 5, you're only discounting by 4.5 and so on. Another set of questions you can get concerns how to calculate terminal value in a DCF. So the most basic one is what are the two methods for calculating terminal value? The first one is the multiples method. So we take unlevered free cash flow or EBITDA, assign a multiple to that, and use that to get to the company's enterprise value. Or we use the Gordon growth method. We assume that a company grows indefinitely into the future and that its cash flows eventually slow down to a fixed growth rate year after year. In terms of the trade-offs here, the EBITDA multiple method is used more often when you have no real insight into what a company's long-term growth rate might be. I would say in investment banking, most of the time you use the multiples method. The growth rate method might be used if you are working in an industry that's cyclical, so maybe semiconductors or chemicals or something like that, where you don't know what the multiples are going to be, where they change quite frequently, but where the long-term growth rates are easier to predict. It's hard to say which one will give a higher or lower value, and if you get a question like that, I would just say that you can't really say, and it depends on a lot of other variables. So it's hard to say whether the multiples method or the Gordon growth rate method will really give you a higher or lower value. You could also get questions on how to pick the EBITDA multiple or the long-term growth rate. For the EBITDA multiple, normally you base it either on the public company comparables, as we did here, where we went in and saw that the median was around 7x, or you could base it on what the company is currently trading at, and then do a slight discount to that to reflect the fact that the multiples will probably come down 5 years into the future. For the long-term growth rate, normally you base it on the company's free cash flow growth rate historically, or according to the projection model here. Or you could look at metrics like the GDP growth rate, the rate of inflation, and base it on that. You always look at a range of values here as well, so you always do sensitivity tables based on these. It's never just a standalone value. You could also get a question on what has the biggest impact on the final output here. So there are a lot of different variables: revenue growth, margins, discount rate, terminal value. So which of these really has the biggest impact? So I'll just list a few of these on the side over here. So revenue growth, margins, discount rate, terminal value. For this one, the short answer is that the terminal value will pretty much always have the biggest impact, simply because most of the time it's going to comprise over 50% of the value in a DCF. After that, revenue growth, margins, discount rate, these all have a substantial impact, but it's hard to say which one specifically is going to have the biggest impact. It really depends on the company and the numbers that you're looking at, but most of the time terminal value is going to have a larger impact than any of these. Just to illustrate this, let's say that we increase the terminal value here, the terminal multiple, by 10%. So we change it to 7.7x. We see that our implied price per share goes up by around $10 per share here, $12 per share. Let's change that back. Now let's say our discount rate goes up by 10% here, so we change it to 11%. So here we see that the implied price per share goes down by around 7. So in this case, it looks like the EBITDA multiple has around twice the impact of the discount rate. Now that's not always true, but it is true that in general, the terminal value will have more of an impact than these others. And the specific impact of these really depends, again, on the numbers and the company, so it's hard to say anything definitive here. Another question you can get is, what do you do in a DCF if you don't trust the company's projections? So if you don't believe that they can really hit these revenue or EBITDA numbers, what can you do? There are really a couple answers to this. One is that you could just discount them yourself. So you could just say, we don't believe that you're going to hit 81 billion in revenue, so we're going to discount this by 10%, let's say, each year. And so you'll only hit 73 billion in year 5, for example. So you could apply your own discount to their projections. The other thing you could do, probably the more sensible approach, is to do a sensitivity table. So you could make a sensitivity table around the assumptions, and then that would let you assess what happens if they don't hit the revenue targets, what happens if they do hit those revenue targets. So those are a couple of approaches you could take to dealing with that. Another question here is, why do you use 5 years for the DCF projection period, and what type of range do you pick for the years here? The short answer for this one is that you normally choose somewhere between 5 and 10 years for a DCF. The reason is because beyond 10 years it gets very difficult to project reliably, so you like to pick something a bit smaller than that. And you normally need at least 5 years, because anything less than that, it is hard to make very meaningful data around that, and it's hard to get values that really mean something in terms of the present value of the free cash flows, for example, if you have only 1 year, 2 years, 3 years. So normally you like to pick somewhere between 5 and 10 years for the projection period here. On a related note, you might get asked about the flaws with a DCF analysis like this. And really the main flaw is that it's just too dependent on future assumptions. A DCF analysis like this depends on variables like a discount rate, the EBITDA multiple, the growth rate, and as you can see with our sensitivity tables, these all have a huge impact. And you can assess the impact and minimize it a little bit by looking at sensitivities, but when all is said and done, if you have a difference of $100 per share between the best case and the worst case here, that's huge, and it's showing you that a DCF is really, really sensitive to variables that are very difficult to predict. So that's really the main flaw with a DCF. Another interview question here is, when you're looking at sensitivities, what types of variables do you look at? And I really think there are four that you could look at. One is revenue growth. One is EBITDA or other profitability margin. The next one is discount rate. And then the last one is terminal value, so either growth rate or multiple. So those are really the four key variables, and you could look at any of these in any combination. That's what you would really use for sensitivity tables in a DCF like this. In our case, we have selected these last two, discount rate and terminal value, and we've done some sensitivities around those. Then one final question you can get on a DCF, especially if you're working in an industry group or something that deals with only a certain type of company, is when would you use something other than a DCF to value a company, and what exactly would you do? So for certain industries, you don't exactly follow a DCF. Examples would be energy, real estate, and financial institutions. And for each of these, you follow something similar to a DCF, but not exactly the same. In the case of energy and real estate, for example, much of the value is based on the assets that you own. So instead of starting with a revenue growth projection, you start with projections based on your assets, your net asset value, and then you go from there to figure out what a company's free cash flow is. So the concept is the same, but the execution there and the implementation is a little bit different. For financial institutions, what you do is you do something called a dividend discount model instead. And basically, the idea here is that for a financial institution like a bank, it doesn't make any sense to look at unlevered free cash flow, because interest is a huge part of a bank's business model. That's how they earn revenue. So what you do instead is you look at their dividends and their PE ratio and their EPS, and you do an analysis based on that instead. The basic steps are that you project out EPS and dividends. What you do here is you essentially try to project a bank's earnings per share and then how much they pay out in dividends, the dividend payout ratio. And then you would discount the dividends instead, and then you would get to terminal value based on PE and EPS instead. And then you would add these together, and that's how you would arrive at your value for the bank. Now there's a lot more that goes into it than this. This is just the basic overview, but that is how you would do a dividend discount model for a bank or financial institution. And again, it's different because interest is a critical part of their business model, and also because the way they use working capital differs from what a normal company here might do. So that's an overview of some of the most common interview questions you could get on the topic of discounted cash flow analysis. Hopefully you have a better idea of how to answer those types of questions now, and you're better prepared when you encounter these questions in interviews. Coming up in the next set of videos, we're going to be getting into more detail on how to calculate the discount rate. And we'll be looking at something called the weighted average cost of capital and seeing how to calculate this, what it's based on, and some of the finance theory that goes into the actual calculation for a more precise discount rate.